Welcome to another Life Lessons. If you're looking to understand life insurance, you're in the right place. Today we're going to talk about some life insurance terminology, and we'll begin with all the various people that might be involved in a policy. The first one being the insured, which oddly enough, that's the person who's insured by the policy. So that is the person whose life will trigger whether or not a life insurance policy will pay out. If the insured dies, the life insurance policy pays out. If the insured's still alive, then the policy doesn't pay out. The next person is the owner. Sometimes these are the same people. You might own a policy on yourself, but also very often these are two different people. The owner is the person who controls the policy. They are the one, if you compare it to a car, that's the person whose name the title is in. You can drive somebody else's car, but if their name's on the title, it's still their car. So you can have somebody insured. Maybe you own the policy, but it insures your spouse. Maybe it's business partners that are insuring each other. Maybe the business owns the policy. Maybe they own each other's policies. But the owner is the one who determines whether any changes are made to the policy. They control whether the policy gets surrendered or stays in force. They are the one to whom the privacy laws apply. So if you want information about a policy, you must be the owner or have permission from the owner. They are the one who receives any distributions if a withdrawal is made from the policy, or and also are responsible for any taxable income generated by a policy. So the owner is a pretty big deal. The beneficiary, that's who gets paid. So if the insured dies and the claim gets paid, the beneficiary is the one in whose name the check will be made. You can have a primary beneficiary, you can have a contingent beneficiary. The primary beneficiary, if they are still living, that is who gets paid. The contingent beneficiary gets paid if the primary beneficiary is no longer living. So an example, you might name your spouse as your primary beneficiary. You might name your children or your trust as a contingent beneficiary. That way, if you and your spouse die, maybe in a car accident together, or you die at the same time, or your spouse dies and you just never get around to changing your beneficiaries, then that means your contingent beneficiary will be paid instead. The last person, and this is a little bit more unusual to have this person be different than other people on the policy, but this person is known as the payor. The payor is the one paying the premiums. So it is possible to have somebody own a policy and have somebody else paying the premium. Again, a common example would be you own an insurance policy on your business partner, but the business pays the premiums. It's theoretically possible for the insured, the owner, the beneficiaries, and the payer to all be different people. Next, we will go into some common policy terms. The first one being the death benefit. The death benefit is how much money is paid out if the insured dies. This amount can also be known as the face amount of the policy. It might be listed as the benefit amount. So if you're looking at your policy, this is simply the amount that gets paid out upon death to the beneficiary. The next thing you might see, depending on what type of insurance you have, is a cash value. This might also be called a surrender value or an accumulation value. This is, you can think of it like the equity in your home. You may have a $250,000 life insurance policy and you've paid some money, some premiums in, and it's built up a cash value. If you decide you don't want the policy anymore, the cash value is how much money is actually sitting in that policy. The next item is a surrender charge. Now, if you were to surrender the policy, that is, give up the policy and not have the coverage anymore, in exchange for the value, the cash value that you've built up in the policy, depending on how long you've owned the policy, a surrender charge may apply. A surrender charge is simply a fee that the insurance carrier will deduct from your cash value before they distribute the balance of it to you. This leads us to the phrase net surrender value as opposed to gross surrender value. So gross surrender value is how much money is actually in your policy. Net surrender value is how much will you end up with if you actually surrender the policy. So there you go. A few simple terms for life insurance policies. If you want to know more or you have questions, leave them in the comments. Visit our website at www.cfg4u or follow us on Facebook, and I'll be happy to help you out.